So whether you're 18 years old or you're stuck in the rental cycle that you've been renting for years and you don't understand the process of getting a mortgage, I'm here to walk you through it. A very elementary level to put you on the right path and make home ownership a possibility. So let's get into it. Let's talk about it. Let's talk about the 4 C's of getting mortgage ready. We're going to start first with talking about your credit. How to establish your credit, what is made up of the credit, and what's the responsible way to manage your credit. Then we're going to talk about your capacity, which is your income, establishing your income, knowing what your debt to income is. And then we're going to jump into the cash part, what you really need to purchase a home. How much money do you need saved? And then we're going to talk a bit about collateral. What type of property are you looking at? So let's get into it. Let's start with the credit. Credit is a thing that you're going to establish, and you have the ability to start that when you turn 18 years old. Now, it can be a challenge when you're 18 years old because who wants to trust someone that just graduated high school to go into a bank and borrow money and rely on paying it back? Sometimes borrowing money takes a cosigner. A cosigner is someone who would be willing to sign and pay back the obligation should you not pay it back. So let's talk a little bit about walking through those bank doors to obtain credit. So the first step is you're going to borrow very minimal money. Now, one way to make it easy to borrow money is if you have a savings account or a CD that may have a couple of $1,000s in it. You can actually have the bank to secure your loan against your own money. And the intentional purpose of this is establishing and building credit. So when you're establishing and building credit, the important thing is establishing what's called long-term credit. Long-term credit are trade lines 12 months and beyond. If you go into some of these places, they will easily loan you the money, $500. However, it's short-term. They're high-risk credit agencies. It's not the best place to borrow because after you make 3 payments, they convince you to refinance that loan, borrow another $100, and then start the cycle over. Also, the problem is the interest rate is ridiculous. It's calculated out to possibly be 300% by the time you pay the fees and everything. So my recommendation from establishing credit is, number one, the bank that you bank with, potentially put that into a CD or something, borrow your own money, establish a minimum of 12-month repayment period. Another option with credit, and you have to be very responsible with this, is going to be a credit card. Now, here is my recommendation for a credit card. Get a small limit, $500, $1,000. However, do not use it to the limit. Use it for putting gas in your car, maybe going out and getting your groceries or going out to eat, but you want to limit how much you're going to put on that. The rule of thumb is you want to keep your balance on a credit card to 35% or less. So when your credit is pulled and you have a $1,000 limit, that the balance is only around $300 or less. I also recommend pay it off at the end of each month because no one wants to pay interest on that. However, be very careful. Do not get caught in the trap of saying, I'm going to pay the minimum this month and then I'm going to pay it off next month, because then your interest accrues, you go out and shop more, and then your credit card is to the limit. So it's very important when you're going to manage your credit that is the key word, is that you are managing it. It's not managing you. You don't want to be in a situation where now you've opened 4 credit cards and you've got all of your balances are to the limit. That's going to hurt your credit. It's not going to establish it. The other thing is when you're establishing your credit, be very careful not to open all kinds of accounts at the same time. You want to strategically do this to build your credit. And at the end of the day, if you are going to open a credit card, then you want to open only maybe 1 or 2. Do not go into the department store and get 10% off, and the next thing you know, you have 10 department store cards. That's not going to help. Having a few is okay. From the credit standpoint, the important part is establishing and managing. And we're going to talk about your debt to income later in capacity. But the big thing is a lot of people are eager when they go and they start a new job or a new employment, and they're making good money and maybe they're living at home or they have no primary expenses. the one thing they want to do is they want to go buy a vehicle. They want to go buy a car. So then they find that they have over obligated themselves by the time it's time to purchase a home. So you do want to manage it. You do want to be responsible with it. You do want to keep it limited on how much you borrow because you're trying to prepare to purchase a home. Now, you may be someone who does not want to follow the traditional aspects of establishing credit. There are alternative solutions that you have to keep in mind, such as alternative credit. So alternative credit is based on these trade lines that are not yet reporting to the Bureau. There are right now bills and policies in place to have things like rent reported. It's in the process. It's in the works. It's called the Vantage Score. But currently, we're not working off of that. So what you want to do to establish alternative credit that's not necessarily reported is you want to have bills in your name, not in mom and dad's name, not in grandma and grandpa's name. These bills need to be in your name. To be taken as a serious buyer for a house, one of those preferred bills is rent. So if you are renting, then we can count that as an alternative trade line. We're going to, once again, want to see a minimum of a 12-month history. If you're renting from an apartment complex or a property management company, then that's perfect because we can do what's called a verification of rent, and we can obtain that information to show that you have paid your payment on time. So that's one source of alternative trade lines. Another source would be, or let's back up, let's talk about the rent. Now, if you're renting from a private landlord, it's not uncommon that private landlords say, hey, just pay me cash. Okay, here's the problem with cash and paying a landlord that way. If you apply for a program and they want verification of rent, we cannot verify that paid based on cash. A lot of times clients come back, or the landlord even mentions this, says, I can give them a receipt for it. Well, that's great because I can go down the road to the store and get a receipt book and write as many receipts as I want. So if you're paying a private landlord, you need to have a source of documentation for that transaction, preferably a check. Nowadays, if you even have a Venmo transaction to the landlord or Zelle or Cash App, all of those are fine. A copy of a cashier's check where you pay them monthly, a copy of a money order. Those are all valid ways that you can verify rent. Cash is going to make your life a lot harder trying to validate it that way. So from the rent outside of that, other alternative trade lines, if you're not one who wants to obtain debt from the typical standard of ways, it would be having bills in your name. Cell phone bills, that's a classic one. Get off mom and dad's cell phone bill, go get your own, establish your own cell phone bill. If you're renting, having the utilities in your name, the water, the electric, the internet, all of those can be sources that's in your name. Another popular avenue we verify alternative credit is going to be your insurance, so your car insurance. Now, back again, the most important thing is these are in your name. If you have these in mom and dad's name or somebody else's name and you say, oh, I'm the one making the payment, it doesn't count. The accounts need to be in your name. And there's ways that we validate. And once again, 12 months. Keep in mind, 12 months is the biggest key when you're establishing or building your credit to establish what's called long-term credit. So overall, to be prepared, you don't have to go out and get a car payment. You know, a lot of people, oh, to build your credit, go get a car. That's going to over-obligate you. You just need to start managing your credit, taking out a small credit card, taking out a small installment with the bank, paying it back. 12-month history is key on that. So that will put you ahead of the game. So if you're 18, if you've established those when you're 18, you're going to be ready to go in about 12 months based on the credit. So that covers a lot of the information on the credit. There's probably more in detail we could go into, but that is a very good roadmap to get you established. So the next thing we're going to jump over and we're going to talk about is capacity. So your capacity is made up from your employment and from your income. There's a lot of misconception when it comes to employment and to income. I have been able to help people as young as 19 years old to purchase. And then there have been people that have been older than that that I have not been able to help because of the employment, because of the income. So let's talk about it in regards to what is required. 2 years employment history is what we're looking at. You may be asking the question, how does a 19-year-old qualify based on that scenario? So number one, we can validate they've been in school. We can factor that in. And then the other thing is we're looking at their job history. You don't have to be 18 to start work. You could actually start working at 16. So even if the previous jobs before going full-time were part-time, it's validating it to your job history. Also, it's validating that they graduated from high school. They've received their diploma. We can factor a lot of that in. But to make the case, it has to be a strong case, is that when they start their new employment, the income is consistent, their debt to income is low, and they've established good credit in that aspect. The other thing is, when we're looking at income in that 2-year history, it's very important that we have a consistent history. So a consistent history is going to mean that there's very minimal gaps and there's not a lot of job changes. Now, depending on your type of industry, it may be there may be a reason that you have multiple job histories. For example, if you're in a union, you may work for a contractor for 2 months and a different contractor for 3 months. And at the end of the year, you have 5 different W-2s. That's okay. That's fine because that's the type of industry you're in. Same thing for in the health field, a nurse may work multiple jobs over that time. However, if you just job hop for no good reason and they're not associated together, that's going to create a challenge of getting you actually ready to get approved for a loan. So in the 2 years, we're looking at the consistency. Did the job transitions, did it make sense? Was there an increase in the pay rates? And how is that going to be looked at? From the standpoint of the income, it is really going to be based on what type of income you are. The easiest source of income is obvious. It's salary, is making a salary. When your employer pays you consistently, day in and day out, the same pay, and it doesn't matter based on your work hours, that is the ultimate easiest way. However, majority of people are paid hourly. So your hourly income is going to heavily impact your qualifying income. If you work a shift or a job and 1 week you get 42 hours, the next week you get 36 hours, is what's considered a variable income position. Variable income makes us go back and it looks at a couple of years of history to truly determine qualifying. So let me give you an example. Let's say you're working a job and you make $25 an hour, but your job workload is inconsistent. 1 week it's 32, the next it's 43. And we look at that, we can't just take $25 an hour and do it over the course of a full year of 2,080 hours. We have to look at the previous history. And so if in the previous history, the income is not consistent, or if it's lower, it could actually damage or it could reduce your qualifying income because it's less than what your current rate of pay is. So variable income is going to require more consistency with the job. Hourly income, it's more preferable if you've been on your job for that 2-year period, because if you have, we can take into factors like overtime, bonuses, shift differentials. All of those require a 2-year history to look at for most programs. Some programs may be a bit more lenient, but if we're talking about a general mortgage, 2 years is the mark to be able to factor in things like overtime and bonuses and commissions. So from that, if you switch jobs and you're an hourly employee over to a new job, now we have to establish what's your average income going to be. So let's take manufacturing, since it's very common. Let's say you leave ABC Manufacturing and you've been with them for a year and a half, and you start at XYZ Manufacturing and you've only been there a month. If your pay stubs are inconsistent, it might take a little bit longer being on that job before we can accurately calculate the qualifying income. So from an income standpoint, the more consistent, the stronger your file is going to be. It's going to be easier to get qualified on the front end. It's going to provide more confidence of knowing what the value of your income is to be able to assess your max qualification for a mortgage. and is going to strengthen the overall file. However, if you don't have a 2-year job history with the same employer, that's okay. We just need to make sure you have a consistent employment history when it comes to that. The other thing with the income is based on what is considered your capacity. So your income, we talked about earlier about your credit. So if you go out and you're making good money, and that's great, but you're spending a lot of what you make, then that's going to reduce your capacity. So from a capacity standpoint, what we refer to in the mortgage world is your debt to income. So if we take a client that makes $5,000 a month, $60,000 a year, then industry standard is going to be 45% debt to income. So a little under $2,500, that's 50%. So let's say around 2-ish. If you have a car payment of $600 and then you have student loans of a couple of $100, that all eats into your ability to afford a new home. So a lot of times when we revert back and we think about the credit, this is why we don't want to overextend ourselves, because we're not ready to purchase if we've got a car payment, if we've got student loans, if we've racked up the credit card debt. So it's all about your capacity. The biggest thing I always recommend to clients when they're intending to purchase, whether they're starting out and they're young, whether they've been in the rent cycle, determine your budget based on what you're looking at, determine that budget, and then you need to find a way to make that monthly payment. If your budget's $2,000 and your rent's $1,000, then you need to be stashing away $1,000 a month so you get used to the cycle of putting away what your new housing payment's going to be. All too often, I talk to clients and they have a budget amount that is a lot more than their rent, but there's no evidence of savings. So that essentially is going to set them up in a period that they're going to fail because they're not used to making that payment. Also, from the capacity standpoint, we as the lender are looking at your gross income, not your net income. So from that aspect, we may be able to qualify you for a lot more than you're comfortable with. But at the end of the day, you're not bringing home $5,000 a month. You may be bringing home $4,000 a month. So it's very important you establish your budget. You establish your goals for what a house payment is going to be. So from the capacity standpoint, just to recap, 2-year history is important. Doesn't have to be with the same employer, but a 2-year history is important. If you have any large gaps during that time, that could hinder the approval process. However, it doesn't eliminate you from being qualified. It just could hinder it, and it depends on how big the gap is. So that's why having a 2-year solid work history is very important. Also, depending on what type of employment income you receive, whether it is hourly, whether it's salary, all of that makes a difference. We didn't really talk into self-employment. I'll just say this very quickly in regards to self-employment. You're going to need a 2-year work history. I advise anyone who is self-employed to use an accountant to file those tax returns. That's very helpful when you apply for a mortgage. But you also need to discuss, if you start self-employment today, you need to discuss with the lender your path to mortgage approval. Because a lot of times clients sit down with an accountant, or heaven forbid, they file their taxes themselves and they write everything off. If we're talking about a capacity standpoint, then we are looking at where you're not going to qualify for anything, because your taxable income that you're reporting after writing everything off is 0. You can't qualify for anything based on your net income that is shown on that. Okay, so the next thing I want to talk to you about is cash. That's another part of the C's, is cash. Now, let's get something out there right now. A couple of things. Myth, you do not have to have 20% down to purchase a home. It is surprising, even in this day and time, how many people still think that's the case, that you have to have 20% down. It's not true. The other disclaimer I will tell you, Yes, there are options for putting 0%. Actually, you can't put 0% down for 100% financing, such as USDA and VA. There are also state agency programs. There are bond programs that will assist for your down payment to cover some or all of it, and maybe even closing costs. So, are there avenues that you could purchase a home and even potentially get your earnest money back? The answer is yes. Is that the greatest way to go? Yeah, depends on your situation. So let me cover the cash thing quickly here. I recommend all of my clients, whether they have to bring any money to the transaction or not, is to save during this time, because there's a lot of things you need to account for. Number one, if you don't use those programs I was talking about, if it's not a VA or if it's not a USDA or a state agency program, you're looking at having to have a down payment. Down payment can start anywhere for conventional around 3%. FHA is about 3.5%. So you need to plan to have that down payment set aside. Beyond that is your closing cost. Buyers have closing costs on a mortgage. It really depends on the amount. It depends on the loan amount. It depends on the purchase price. But a lot of rule of thumb is if it's 2.5% to 3% of the purchase price, that's a good budget. So it depends on the market you're in, whether the buyer's going to have to pay those closing costs or the seller pays those closing costs. Currently, we're in a seller-paid closing environment. I have a lot of contracts that the seller is paying, but maybe not all of the closing costs. So it's very important as you're budgeting your money is to save that amount. Put it in a savings account. Don't touch it. Do not deposit cash into your account during the mortgage transaction. Let's talk about that very quickly. Cash is not your friend. Under your bed, in your mattress, in a shoebox, having it there, and then deciding to buy a house the next month and go put $10,000, $15,000, $20,000 of your cash into the account, it is not the approach that you're wanting to take. Build you a savings account up. Put your money in your savings account. Let it build. Put it in a high yield savings account, something that doesn't carry a lot of risk. Cash is not your friend in the mortgage transaction. So when we're talking about this, even if you don't have to bring any money to the table, you would rather go into home ownership having an emergency fund. I highly recommend it because even if it's a new home, even if it's an older home, there's likely going to be something that needs to be done to the home. Repairs need to be done to the home. You might want to purchase new furniture. There's always going to be something. So as far as the cash, I recommend, number one, if you don't have to bring any money, go ahead and plan on bringing money. Because if you don't have to, guess what? It's still in your account. Number two, plan to pay closing costs even if the seller does. All this is going to do is make you be ahead of the game. So stash away as much of that cash as possible. Worst case scenario, you got it in a rainy day fund at the end of the day. The next thing I want to talk to you about is going to be the collateral. This is the type of home that you're buying. Depends on where you're located, where you're living, but there's different opportunities out there. Most cases, buyers are buying a single family home, meaning it's only one unit. However, what type of home is it? Is it a single family detached, meaning it's your common home in a subdivision or just on property? Or is it a single family attached, meaning that it's like a townhome? Or is it a condo? The common misconception is the difference between a townhome and a condo. So simplicity, the way I've always been taught, is a townhome is attached to that dirt. So the little bit of the dirt that you have on the front and the back, that's your property. Whereas a condo is not the case. A condo is just the building itself. When it comes to financing, there's a difference between financing a condo and financing a townhome. Financing a condo requires approval by the agencies. They evaluate the condo project. They also see if it's approved for VA or FHA. There's approved lists that are out there for those programs. If it's not, you have to do what's called a spot approval on the property. Conventional is a little bit more lenient. They've relaxed the guidelines over the years, so that really helps out. So another popular thing is mobile homes / manufactured homes. Those have become increasingly popular just because from an affordability standpoint. The surprising thing is they've also increased in value. Go ask anyone who has 40 or 50 years or older, and they would tell you they would have never thought there would have been a day that mobile homes would have increased in value. But it's just the world we're living in now. Also, with a mobile home, there's certain factors you have to consider. You want to verify that the mobile home has never been moved from its original setup locations. Majority of programs, almost all programs, are not going to allow that. You want to make sure that it is set up for HUD compliance, meaning that it is anchored down properly. And a common misconception on manufactured homes is that is determined by what someone sees on the outside. So there's the common things with a manufactured home. You either have what's called the skirting, you have brick skirting, you have block skirting, or you may have something like a vinyl skirting. Just because it's a vinyl skirting, none of the skirting matters as far as the foundation of the home. It really depends if they are anchored and tied and it is done in a HUD compliant way. And the way you figure that out is with a structural engineer. So the structural engineer comes out and looks at it. Some common things that I run into with manufactured homes possibly is the life expectancy, the remaining life expectancy. If that's brought up on an appraisal, that has to be addressed because we can't we can't put it on terms longer than the life expectancy of the home. So a manufactured home is a big thing. So another type of popular property now for what's considered house hacking is a multi-unit property. So you got your single family detached that we just previously discussed. So a multi-unit is anything from 2 units up to 4 units. So from a duplex to a quadplex. And for a young person who's potentially looking to get into investing, it's a great way in the door. Now, for me, my wife would never want me to do that. I've threw out the idea when we were young, when we got married, hey, let's buy a duplex and we will let the tenant supplement the mortgage. And she said, I'm not having anyone live beside me. So I got ruled out on that. I think I could have had a pretty good investment portfolio, but she shot me down just like she's done on a few other ideals that I've had. So let's get beyond that. So here's the way it works with a potential multi-unit purchase. For an FHA program, you can get into that in the neighborhood of about 3.5% down, all the way up to a 4 unit. So if you occupy one of those units, your tenants could pay rent on the other 3, and it would help supplement your income. Now, depending on what the size of the unit is, if it's a 2 unit versus a 4 unit, there are different discrepancies from guidelines as far as how much down payments required for your conventionals and what the requirements are when it comes to the debt to income and the tenant usage of the property as far as the rental income allowed to be used. So there's different nuances with that. However, it's a possibility. So if you're a young buyer and you're wanting to start maybe your investment portfolio, maybe take a look at a duplex and see what is the best route there, because nothing would be better than someone else paying your mortgage. And then over time, you can revert that into a investment property, potentially retain it, and then go to your next project. So that covers the collateral section. It really depends on what you're looking at. Is it going to be a single family home in a potential subdivision area? Is it going to be an attached townhome? Are you looking at condos, maybe something in the city, high rise, something like that? Manufactured homes, very popular for young buyers from an affordability standpoint. And then your multi-unit properties. So hopefully this video has helped someone out there that is looking, that really has no idea. Let me tell you this. Please do not be intimidated by asking questions to your lender. If you feel intimidated, maybe you need to work with someone else. You want to work with someone that you can trust that will advise you along the way. Because at the end of the day, we're all humans, we're all people. There's no reason for someone not to look to help and to advise someone in this big move. Buying a home is one of the largest transactions the majority of people will ever make. And so you want to make sure you're into a process that you understand, but you're also working with someone that you can trust to guide you along. A mortgage plan is no different than putting a plan together for your 401k. Your 401k, you're working on building money. With a mortgage plan, you're working on borrowing money against a very large asset that's going to increase in appreciation. So it's important. The plan may take only a month to put in place. It may take 2 years to put in place. But if you don't have a plan, you don't have anything. So make sure you're working with someone who can walk you through the steps, walk you through the stages, adequately give you information on budgeting your money. Make sure they cover the C's with you. What does your credit look like? That they're reviewing it. They're not just telling you the score. They're reviewing your credit with you. Talking about the capacity, your employment, your income, what's made up of it, what can count, what can't count. They're talking about saving money, your cash. What are you doing to make sure you have money and that you're ready, even if you get into the home with no money out of pocket? And then that they are familiar with the property that you're going to buy, whether it's single family or multi-unit. So if you've enjoyed this video, if you could do me a favor, just hit the like button, maybe leave me a comment and subscribe, because I'm going to be putting out additional information to have people ready for home ownership.